What is a rug pull, and what are potential warning signs of a rug pull? If you're standing on a rug and it suddenly pulls out from beneath you, unless it's a magic carpet, you'll tumble to the floor. Even worse, you'll risk spilling or losing whatever you were carrying at the time. That is why, especially when trading a volatile crypto asset, you must be cautious of rug pulls. Let's take a closer look at crypto scams and rug pulls, as well as the potential signs of a rug pull that you should be aware of. What is a rug pull? When developers establish a token coupled with a valued cryptocurrency, then offer the token on decentralized exchanges, and then withdraw all the funds out after the investor buys in, this is known as a crypto rug pull. Rug pulls are generally carried out by con artists who build up a buzz about a coin and then abandon it, taking the money with them. Typically, these coins are linked with dependable utility blockchains such as Ethereum or Binance Chain. This is because investors who exchange their ETH for the listed token allow the token's developers to swiftly withdraw their ETH from the market. Meme coins, for example, are one of the creators that drive investors to succumb to FOMO and be rug pulled. How does a rug pull happen? Rug pulls are most commonly seen in the decentralized finance DeFi area when funds are taken from a liquidity pool. To fully comprehend this, we must first comprehend how liquidity pools work. A liquidity pool acts as a market maker for decentralized exchanges, allowing users to place, buy, and sell orders for specific tokens. Crypto exchanges require a means to keep order flow moving because there is no centralized infrastructure for arranging trades. Because there is no one to audit the token, it is also simple to offer it on a decentralized exchange. A liquidity pool, at its core, is a collection of investor funds locked in crypto pairings that allow users to trade between cryptocurrencies. Because it's a well-established platform token with high availability, most crypto pairings contain a prominent cryptocurrency like Ethereum's. A trading fee is levied on orders and awarded depending on the total value loaned to the pool to encourage investors to combine their resources and operate as a liquidity provider, similar to a dividend. Each user is entitled to a portion of the aggregate fee in return for the crypto in their pool wallet. An investor stands to gain more money if the loan amount is larger. Liquidity pool creators compete for additional investors by providing bigger returns. When the architects of a rug pool have gathered a large number of liquidity sources with significant money, they withdraw all the available assets. The coins are then traded in a different marketplace, making the victims' identities untraceable. Because Ether is often used as a medium of trade, it's simple to move funds between wallets and disappear to other users. This eliminates all crypto assets from the pool, leaving it empty and the liquidity providers disappointed. DeFi protocols, as the name implies, have no centralized control and rely only on smart contracts, making them a potential target for DeFi rug pulls. DeFi has a record number of offences in the first 7 months of 2021. However, investors are becoming more knowledgeable and the amount of cryptocurrency stolen on DeFi sites has decreased by 64%. Bad actors can use DeFi initiatives to produce coins, increase their profile, and attract investors. Tokens are generated and listed without an audit utilizing decentralized exchange platforms like SushiSwap or Uniswap. Scammers only need to develop a token that appears to have some value, offer use cases, and establish a market appeal for investors to invest in it. As soon as money begins to pour into the project, its value rises, and the founders sell their tokens, reducing their worth to zero. They simply pocket the money pledged to the initiative through token sales, pack their belongings, and depart, thereby pulling the rug out from under their purchasers. Because the DeFi area is unregulated, criminals may simply attack it. What are the potential warning signs of a rug pull? Even though exit scams and rug pulls have increased in the previous year, the overall amount of money taken is decreasing as investors learn to recognize the warning signs. It's simpler to avoid these schemes if you know what you're looking for. These are some typical warning signs that you should be aware of to avoid being a victim of an exit scam. Yields are too high, creators remain anonymous, coin prices skyrocket, extensive marketing tactics, no liquidity lookup. How to avoid a rug pull. Investors can reduce their chance of getting entangled by a rug pull by exercising care and looking for signs that I've listed. When entering new markets or investing in new pools, prudent investors exercise prudence. Knowing the signs of foul behavior will reduce one's chances of falling prey. Greed may make bad business decisions appear much safer than they are. Avoiding frauds and possible rug pulls in crypto projects comes down to being aware of the risks and conducting your research before investing. Here are a few techniques to verify a project's authenticity. Check liquidity. Review GitHub, white paper, and social media channels. Confirm team credibility. Look at holders and listings on decentralized exchange platforms. Should you still invest in DeFi and cryptocurrency? I must first issue a disclaimer before answering this question. This is not financial advice because I am not a financial consultant. This is my own opinion, not financial advice. Before investing in any of the various cryptocurrencies available, please conduct your research and due diligence. This is created to help you easily understand the topic with our animated explanations. DeFi is a relatively young industry with a lot of promise. It allows you to borrow money without regard for your credit history. You just need collateral to borrow money. Furthermore, DeFi banking is genuinely private because no centralized authority is in charge of prescribing rules or collecting exorbitant transaction fees. The disadvantage of such an uncontrolled market is that anybody may list an asset since there is no central authority over it. Rug pulls are always there when there's no one else to detect whether a project is trying to defraud folks. As with any new technology, malevolent crypto players will do their hardest to defraud others with less understanding and expertise. Prices for many new ventures might be exaggerated in the near term, and it can be difficult to distinguish hype from reality. Investing in DeFi ultimately boils down to your financial resources and risk tolerance. Before investing in a project, be sure you've done your research and know what you're getting yourself into. Etherscan and other online platforms and tools can assist you in determining the authenticity of investments. Rug pulls are generally meticulously planned and performed. The newly minted tokens promise significant changes and have attracted a lot of interest in a short period. Rather than conducting token sales, the hoax's perpetrators are planning an exit scheme. Investors are typically unaware of this until the token has lost all value and the founders have vanished. The stakes are rising in tandem with the increased interest in cryptocurrency. Scammers are always searching for new methods to earn money off of unexpected victims. You can reduce the risks of being the next victim of an exit scam by keeping note of typical signs and doing due diligence on potential initiatives. There's a pro tip. If it sounds too good to be true, it probably is.